Welcome to TradeTheNBI.com. This is John. This report is for the 14th, Flag Day. And while we were talking about potential weakness, and sure enough, we had a little bit of drama with the FOMC and the Fed's raised rates, which everyone expected them to do. But still, that's not an exciting thing. And, well, the market didn't really flinch all that much. I mean, we just made it back to the ABM yellow after accelerating past it. So hardly the things that dramas are written off of. Much more interesting spike though from the Nasdaq on this. Even though we have the rising shakeout here, we've got a magenta candle, and it split into a very strong steel lower and orange rising. So that could have a little bit more of an extended play. Probably going to need to see the shakeout fade a little bit more for that to take serious hold. And we still had rising red for the most part, but now green's flat, cyan's flat. I mean, those numbers are like all bled right next to each other. Almost impossible to see. You can see that cyan's at the little over positive level. The red right in between here in the mid twos. Green is below cyan at this particular point, and also below red. So even with that mess, you can see that there's some trouble signs, at least from a super rally position. Interesting too that the euro, it cracks me up because they talk about ending quantitative easing, and the reality is they don't do it. So that talk just bolsters it, and this is kind of fun that way. Right now you don't have the U.S. Attacking this setup at all. So in this particular case, clearly European Central Bank wanting to at least define some support for the euro here. No particular reason to either. The reality is lower euro will certainly be more of an improvement for economic growth in the Eurozone, but they don't really seem all that compelled to growing their economies as much as just trying to maintain the stagnation, which is an approach that was tried in America. That we did that for the last 10 years before switching to the more progressive growth model, and it did not have that extreme impact on treasuries. You might have thought that would cause a much bigger move, considering the clear weighting is towards continued rise in rates. I mean, they're projecting another couple more hikes this year, which just seems to be a little bit ahead of the curve, but that's okay. I've been complaining about that. I'll always complain about interest rates and what they do with them. From an oil standpoint, that increase in rates certainly bolsters oil, especially when they talk about money and time being money. Oil oftentimes will act as an inflationary hedge as well as gold. So this isn't a surprising. Plus, we're coming off of this reset play. What we don't have, though, is, and this is critical to see, we didn't get that orange dip below the red. So I just don't see this as being a sustained move. I really think we're going to probably fade out of it. Could be green moves above cyan first, or there's a rejection. But as soon as there is, I think that becomes an excellent short opportunity back to that low marker. So I just have to point out. Modest pivot in gold. I mean, this is really tiny given, and we actually see lower shakeout with it. The extreme's pretty decent. It could just be a brief anomaly coming off of the broader dip, but we really aren't seeing anything spectacular from the chart standpoint, at least even on the DOC that would say, hey, jump into gold at this particular moment. I think it's something you should continue to acquire at lows, but that brings us to the 5K chart. It was bizarre, I think is probably the way to describe it. We had reduced the narrow range, and I was talking about this, where everyone was like, oh, this is getting to be a snooze fest. And that's usually an indication that you're about to break to a broader range. We ended up with a bunch of gold candles here that we were well over the 50%. It did push us right to the highs, but then we got some fairly clean signals as far as DOC spread in that. In this particular case, it was a little more interesting. We ended up with the orange break above, steel below, and at that particular point you had cyan being crossed by the green, and so this is sort of like my beginning trigger point to look for continued breakdowns, because the steel kept falling lower. I thought, okay, maybe that's just a breakdown there, but then we ended up with the what I look for is this beautiful opening right here where you have the cyan rising, green fading. And at this particular pace, though, you get a little bit concerned because you know that you're going to have a little bit of problems, because the turn up of steel and orange is going to be like the closing of a mouth. And in fact, it was, but still produced reasonable decline right back down to the 50%. And at that particular point, we still had orange and steel at that moment within the continuation mode. And then steel crosses above as the decay in the shakeout continues. So from my standpoint, I'm expecting to continue to ride to the lows. And just as we were getting down there, we ended up with that dip right below, unable to cross the 50% with it. And it produced a blue candle at this particular point, but also produced the yellow dot warnings, because we were really down low in the shakeout with the yellow being below magenta. And at that particular point, once we developed a white candle, we were already at the lows, and it produced new lows, which was interesting, because it's what we kind of expected to do, but you don't have as strong a bias target. What you really want to see is this move, which is the pop back up, and kind of the response of what you would expect from the blue candle, even after having made its lows. So it pops up quite extensively and produces this beautiful explosion point right here. I'll just mark it with the... Look at that. So you end up with the strong snake of orange rising, steel falling, cyan moving above red, green crossing below it, and red starting to trail down. And boy, we have a beautiful target, because we're expecting at least to come back to this opening candle right there, if not the lows. So you're down at the 84 range from being up to the 90. And sure enough, not only did we hit the lows, but at that particular point you had no reset, so there was no reason to believe that that was going to change. It wasn't until this dip right here, which fine, but it was a close below 23%. So the worst I'm looking at is it popped maybe to 23.50 at the maximum. But then I make a white candle, and so we already know that we're going to be hitting those lows again. And look at this, we're right in the middle of a new one at this particular point. So, and again, didn't even make it over the 23%. So I think that generally we're looking at a little more downside than up at this particular point. And we'll see if that follows through into the open market. I'm going to be watching pullbacks up to the 50% now. We're seeing declining Fibonacci lines here, but I think that it's an indication that we could actually see some testing of some of those ABM levels from a daily, which nothing wrong with that. A little bit more interesting today. As always, though, I will mention anything that's worthwhile and put them on the Skype chat. Trade well. We'll talk again later.